This really is what keeps me up at night when it comes to pre-construction projects in the GTA. And I know it's what keeps developers up at night too, because they're sitting there thinking, if this risk materializes, what are we going to do when the projects come up for closing? Are we going to offer vendor take back on appraisal gaps? Are we going to take people's deposits, get the unit back, resell at a lower price? How are we going to approach this problem if this risk materializes? Hey guys, Jordan from Precondo here. Welcome back to the channel. Dan Foch recently said on Twitter that there needs to be more conversation around the volume of unrealized losses sitting in the pre-construction pipeline right now, and I tend to agree with him. It's something that I think about a lot, and I wanted to cover it in this video here. And in order to set the stage, we first have to acknowledge that pre-construction condo and freehold prices are higher than resale prices, right? So if you take an apples to apples comparison of an existing detached home versus a pre-construction one across the street, or an existing condo versus a pre-construction one across the street, the pre-construction one is going to be more expensive in 99% of cases. So you can see on this chart from Urban Nation here, new condo prices in the light blue versus resale condo prices in the dark blue. And you can see that resale prices corrected as a result of COVID. They started to head back up. But of course, new condo prices didn't see that same correction. It is no different in the freehold market either. The freehold pre-construction prices, the chart looks a lot like this, up and to the right. And the truth is, pre-construction has always been slightly more expensive than resale, but in the last 3 or 4 years, that gap, that premium that you pay for pre-construction has widened considerably over resale market value. And I've covered it extensively in other videos, so I won't talk about it too much at length here, but really the two main reasons why that is because building costs through COVID rose considerably. And of course, development charges that municipalities charge developers for the right to build in their city have gone up dramatically as well. And these are two of the biggest line items when it comes to building a new condo or building a new home. Now, historically speaking, paying a premium for pre-construction condos and hoping that the value goes up between now and closing has worked out quite well. So essentially, if you're trying to make sense of this graph, basically this means that if somebody closed on a condo in 2022, on average, they paid $472,000 for it pre-construction, but the MLS benchmark price is now $703,000. Now, important to keep in mind, and part of the reason why this risk has never yet materialized in the condo sector is that when you close on a pre-construction condo in 2022, you likely purchased it 4, 5, or 6 years ago, and that's why the purchase price is so much lower. At that time, 4, 5, and 6 years ago, that price was probably a little bit more than what a resale comparable was, but of course the market has appreciated considerably in the interim, and so you've done really well on that investment. For this video, rather than looking at the GTA as a whole, I wanted to look at specific examples of pre-construction launches versus resale prices and where they are today in the build cycle. So we're going to zoom into the Moss Park neighborhood of Toronto, which is a neighborhood that's seeing a lot of pre-construction lately, and you can see here that while prices have done well over the last 9 years on a per square foot selling basis, from 2020 through 2023, we've really seen no change in selling price per square foot. And this could potentially pose a big issue, right? Because launch prices of new product in this neighborhood from 2020 through today have risen considerably. We're going to look at a couple of condo launches in the Church Street corridor right near Moss Park and compare them to a comparable resale building. Now, what drives me crazy, especially on Twitter, is when people see a condo launch in the downtown core at like $1,500 a foot and they say, well, the Toronto average price per square foot for condos is $1,000. So this is 50% overpriced. That's not really true. And it's certainly not a fair comparison because when you look at the average per square foot selling price of a neighborhood or of all of downtown, you are rolling in all kinds of 20, 30, 40-year-old condo buildings, which are not a comparable to your building. No bank appraiser is going to look at the average per square foot in a neighborhood. They're going to look at a comparable building nearby. So what I took for this comparison was a resale building in the Church Street corridor that is 4 years old and is very comparable to these two launches that we're going to look at. So Project A launched in 2020 at $1,350 per square foot. So that put the launch price, the price on day one sales, at $258 a square foot over resale, or about a 23% premium. And you can see here that this project is projected to close in 2024. Project B launched a year later in 2021 at $1,415 per square foot, which at the time was $150 a square foot over the average at 85 wood. So about a 12% premium on this particular project here. And what I have in the gray line on this chart here is basically if the market trades sideways going into the future. So the assumption that this chart is making is not that resale prices go up and not that resale prices come down any further, just that they stay flat. They stay flat from where they are today at $1,279 a foot into the future in perpetuity. Now, obviously, that's not going to be what happens, but I wanted to use this as our base case assumption to give you an idea of the risk that's lingering out there in the pre-construction market. So if resale prices don't go any higher and they don't come down any further, this is what you're looking at. You're looking at closing on project A at a $71 per square foot premium, so about a 5.5% spread. That's probably not that much of an issue because the building is brand new in 2024, whereas the resale building we're looking at is 5 or 6 years old. So I feel like appraisals will probably come in for most of those units. However, it's worth noting at this point that not everybody who bought Project A bought it at the launch price. Some people bought it later into the sales cycle when prices would have been considerably higher. And with Project B, for example, a later launch, they were at a higher price. And so, of course, their spread is larger. You're looking at an 11% spread over resale or $136 per square foot over resale. So there's no question there's going to be some appraisal gaps on units that are closing in that building. And this chart does a good job of illustrating the timeline, right? So you can see that on earlier launches, 2020 and prior, you have less of a spread, of course, because you paid a lower price. And then on later launches, 2021, 2022, you of course paid a higher premium over resale at the time, and resale hasn't done much in the interim, and so your spread is even wider. To illustrate this further, I took a unit from a building that I pre-sold a lot of units at. This particular unit just sold on the resale market. The building's complete and done right at High Park. It just sold for $660,000. It is a 1-bedroom and den, 570 square feet. And this unit would have been purchased September through November of 2018 for $502,000, including parking. So the unit is up $158,000 or 31%, even in the current resale market conditions. Now, it is impossible to paint with a broad brush, right? There are projects that are well priced, there are projects that are not so well priced, and there is everything in between. But if I had to throw years and timelines at you, I would say that generally speaking, 2017, 2018, and 2019 condo purchases for the most part are okay. As far as 2020 launches, there are a lot that are underwater. There are some that aren't. And 2021 onwards, pretty much all of those units are currently underwater, with rare exceptions that break the rule. Obviously, there was one launch just off the top of my head that launched at Islington Station. It launched at $1,000 a square foot. Resale buildings right next door by the same developer are currently selling today for $1,000 a foot. So nobody's underwater there. But again, that's just one example. Based on our assumptions, what we're basically saying is anything prior to 2020 is probably okay, and anything after 2020, not so much. So what sold post 2020? Well, we have the numbers from Altus here. So you can see that you have the total number of condos and freehold in the GTA sold 2020 through 2022. In total, 74,000 condos and 35,500 freehold properties. And I wanted to put some sort of value on this. So back of napkin math here, don't take this too seriously. I just wanted to get a rough idea of how much unrealized losses there might be floating out there in the ether. Based on Altus's benchmark price for new freehold and new condo sales, you can see that 2020 through 2022 has a total value of commitments, right? Buyers purchasing and agreeing to close on a pre-construction condo of $83.7 billion and freehold at $62.2 billion. So if we assume a conservative spread of 5.5%, you're talking about $4.6 billion in losses on condos and $3.4 billion in losses on freehold. And if you assume a more bearish spread of 11% on average, which was our Project B example, you see that there's losses of $9.2 billion in condos and $6.8 billion in freehold. So what does that really mean in practice? Well, what that means is if there's no resale lift between now and the closing of these contracts, right? Meaning the resale market doesn't go up, it doesn't come down, but it doesn't go up. You're currently looking at anywhere from $8 billion to $16 billion in unrealized losses, which may not sound to be that much, right? But you have to remember that Toronto's GDP is $440 billion. So you're talking about 2 to 4% of our GDP sitting in unrealized losses on pre-construction. Of course, you could make the argument that in the last decade, pre-construction homes have typically always been more expensive than resale, and so these losses have always existed. And I would tend to agree with that argument. The only difference today is there's actually risk of that risk materializing because resale isn't going up. Now, the other headwind I haven't talked about is Put aside appraisal gaps, put aside people having to come up with cash or builders having to offer vendor take back or take units back and keep people's deposits. Put all of that risk out of your mind. Let's say appraisals come in on these projects. It's important to remember that a lot of the people who bought these freehold and condo properties are actually investors. And despite the fact that rents are absolutely ripping right now, they're still going to be deeply cash flow negative as a result of current interest rates, assuming that they're borrowing 80% on those properties in order to close. This is a chart from Ben Rabideau on Twitter that just shows the current monthly cash flow index for Toronto condos. And you can see that even adjusting for principal repayment, because you're repaying so little at current interest rates, your negative cash flow on your average condo in Toronto. Now we get to the other side of this argument. And the other side of this argument is essentially, sure, this risk exists and it has always existed to some degree in the pre-construction market, but the reason it's not going to materialize or hasn't materialized in the past is simply because we are critically underbuilding homes in Southern Ontario. So this is a chart from Daniel Foch that shows how many homes we built in 2022 versus how many we needed. So in order to determine how many we needed, 192,000 home completions, what he did was he took the total population growth, 504,000 people, and divided it by 2.6 persons per household, because that is the number the census gives us. So on average, 2.6 individuals live in each dwelling. And so that gives you a rough estimate that in order to keep up with population growth, we needed to see 192,000 home completions in Ontario, but we actually only saw 72,000. So we are critically underbuilding. And the truth is, for the past 2 decades, Ontario has been underbuilding, but it's even worse today than it was over the past couple of decades. And the population growth appears to, at this point, be continuing. So I made a video what feels like 3 or 4 weeks ago when Canada's population officially passed 40 million. And in the past 3 weeks, we have gone up another 151,000 people. So the population growth right now currently isn't slowing. You stack all of this on top of the fact that completions in Toronto are already low and on a per capita basis, one of the lowest in Canada. And finally, you get to the point that it's not going to change. We're not going to suddenly break ground and build hundreds of thousands of more homes that we desperately need. You can see that residential building permits are falling very dramatically. Why are they falling? Well, they're falling because nobody's placing orders. You have to remember, housing is built when you place an order. If the pre-construction homes and condos aren't purchased by somebody, they don't get built, right? And you can see that year to date, freehold sales are down 9% year over year, and condo sales are down a whopping 61% year over year. So we were underbuilding previously. Well, in the near future, we're going to be underbuilding even more, I guess. I don't really know how to word that, but the situation is not good for affordability. Just leave it at that. We know affordability is bad. Everybody's complaining about rent. At the same time as renters complaining about how high rent is, you have landlords complaining about how high carry costs are, right? So the situation is dire as is. And if you look at June specifically, Toronto just cracked 2,500, the first time in history that a 1-bedroom in Toronto on average is going to cost you more than $2,500 a month in rent. So I guess this leads me to the final point here, which is that I don't see housing affordability getting any better over the next decade. I do think, though, that over the next couple of years, there's going to be a lot of pain in the market for people who bit off more than they could chew. And by more than they could chew, I mean they signed for more units than they could afford to close on. I'll leave you with that, guys. I hope you enjoyed the video. Would love to hear your thoughts in the comments below, and I'll see you guys next video.